Donald Trump's tax reform, widely known as the Tax Cuts and Jobs Act (TCJA) of 2017, is often considered to have widened the income gap between the wealthy and the middle class. By analyzing the Act's provisions, distributional effects, and broader economic implications, this discussion aims to provide an in-depth understanding of its outcomes. Donald Trump's tax reform primarily benefited the wealthy, exacerbating income inequality in the United States. This conclusion is supported by evidence from multiple studies and economic modeling frameworks. The following sections elaborate on the reasons for this conclusion. The TCJA significantly reduced the corporate tax rate from 35% to 21%, and introduced substantial tax cuts for high-income earners. According to Bhattarai et al., 2017, 70% of the benefits of Trump's tax cuts accrued to the top income decile. This disproportionate allocation is a critical factor in widening income inequality. High-income households, whose wealth is predominantly derived from investments and capital gains, benefited from provisions favoring capital over labor. For example, the TCJA's reduction in the taxation of pass-through income directly benefited business owners and the ultra-wealthy. The reform's impact on corporate taxation further amplified income disparities. Corporations redirected much of their tax savings towards stock buybacks, rather than wage increases or new investments. Data 2023 highlights that while the financial sector and shareholders reaped enormous gains, the benefits did not trickle down to workers, as proponents of supply-side economics had predicted. This imbalance underscored the failure of the trickle-down approach. The TCJA's effects on the middle class were mixed but generally underwhelming. While the reform included modest tax cuts for middle-income households, many of these provisions were temporary and phased out over time. For instance, changes to the standard deduction and personal exemptions initially provided relief, but failed to offset the growing cost of living and stagnant wages. Batchelder 2016 estimated that about 8.7 million low- and middle-income families, including single-parent households, faced tax increases under the plan due to the elimination of personal exemptions and adjustments to the child tax credit. The middle class, which had already faced decades of wage stagnation and rising living costs, found little solace in the TCJA's temporary provisions. While the expansion of the standard deduction and the child tax credit initially offered some relief, these measures were not enough to address the broader economic pressures facing middle-income households. Many families struggled to achieve financial stability, and the reform's temporary nature further eroded the potential for long-term benefits. The stark contrast between the temporary relief for individuals and the permanent tax cuts for corporations emphasized the inequitable distribution of benefits. The TCJA also had broader economic implications. While it stimulated short-term economic growth, this came at the expense of long-term fiscal sustainability. The reform significantly increased the federal deficit, which rose by over $1.5 trillion within a decade of implementation. Bhattarai et al. 2017 noted that maintaining such deficits without severe government spending cuts posed significant risks to the U.S. economy. Additionally, the promised growth in investments and productivity gains did not materialize to the extent anticipated, further questioning the effectiveness of the policy. The increased deficit, compounded by the reform's regressive nature, raised concerns about future economic stability. Critics argued that the rising deficit would necessitate cuts to essential public services, including healthcare, education, and infrastructure, disproportionately affecting low- and middle-income families. The burden of addressing the deficit, therefore, fell on those least equipped to shoulder it, further exacerbating economic inequality. Income inequality in the United States had already been widening for decades before the TCJA. The reform exacerbated this trend by tilting the tax system further in favor of the wealthy. Data 2023 argues that the concentration of wealth among the top 1% has reached levels not seen since the 1920s. With the TCJA acting as a catalyst, this concentration undermines economic mobility and the middle class's ability to achieve the American dream. The reform's impact on economic mobility was particularly pronounced. By favoring capital gains and corporate profits, the TCJA entrenched wealth among those who already held substantial assets, creating barriers for middle and low-income families to build wealth. The reduction in estate taxes further compounded this issue, allowing wealth to be passed down across generations with minimal taxation, thereby entrenching economic disparities over the long term. Furthermore, the TCJA's international tax provisions incentivized profit shifting by multinational corporations. By allowing a reduced tax rate on repatriated earnings, corporations exploited loopholes to shift profits offshore, depriving the U.S. government of critical tax revenue. This practice, as described by Data 2023, further entrenched income inequality by benefiting corporations and their shareholders at the expense of public services and infrastructure investments. The reform also failed to address structural issues in the U.S. tax system that contribute to inequality. Critics argue that the TCJA's emphasis on reducing corporate and high-income taxes perpetuates a cycle of wealth accumulation for the privileged few, while neglecting the economic struggles of the majority. Data 2023 emphasizes that this approach undermines the social contract of shared prosperity and contributes to a divided society. Proponents of the TCJA contend that the policy's long-term effects, including increased economic growth and job creation, justify its initial shortcomings. However, empirical evidence does not fully support these claims. Bhattarai et al. 2017 and Batchelder 2016 highlight that the reform's benefits were concentrated among the wealthy, with minimal impact on wage growth or employment opportunities for middle and low-income workers. Additionally, the promised economic growth from corporate tax cuts often failed to materialize, as corporations prioritized shareholder returns over investments in labor or infrastructure. Moreover, the TCJA's reliance on supply-side economic theories has been a subject of significant criticism. Data 2023 and other economists argue that the trickle-down approach, which assumes that benefits to the wealthy will eventually reach lower-income groups, has repeatedly failed to deliver equitable economic outcomes. Historical evidence suggests that such policies often lead to greater wealth concentration, without addressing the underlying challenges faced by middle and low-income households. In conclusion, Donald Trump's tax reform widened the income gap between the wealthy and the middle class by disproportionately benefiting high-income earners and corporations, while providing limited and temporary relief to the middle class. The TCJA exacerbated existing economic disparities. Its broader implications, including increased fiscal deficits and limited trickle-down effects, further highlight the reform's shortcomings. Addressing these issues requires a re-evaluation of U.S. tax policy to prioritize equity and long-term economic stability. The TCJA serves as a stark reminder of the trade-offs between growth and equity in tax policy, and its outcomes underscore the need for more inclusive economic strategies moving forward.